This is Retirement News Online. I'm Scott Drake. When it comes to retirement planning, taxes actually don't stop when your paycheck does. In fact, when it does become time to tap into your retirement nest egg, it comes with all sorts of regulations and some opportunities. In fact, some are surprised to find out that when they retire, they actually go into a higher tax bracket. My guest is Greg Dupont in Dublin, Ohio. Greg, welcome back. It's good to talk to you. So when somebody retires, obviously the assets they've accumulated now has to be turned into income, and that can cause some tax problems.
Well, Scott, that's absolutely correct. What people fail to understand is that by giving us the benefit of the 401k and other type of deferred retirement plans, the IRS created a ticking time bomb, and they want their money back sometime. And that's what most people fail to realize. And then when they start in retirement, they find that they are paying sometimes higher taxes than they were during their lifetime because of that ticking time bomb.
So when you're thinking about an IRA, they come with required minimum distributions, or RMDs, which some people don't like. And with a Roth, you do get tax-free withdrawals, but you're paying taxes up front, and that can cause problems, can't it?
Yeah, the structure of the tax system, when the IRS created, or the legislature created the Roth, they gave us the opportunity to have some of our seed taxed, and then we get the crop without the taxes, as opposed to most people's retirement plan when they have not done the Roth, where the seed is not being taxed, but the crop is. So you've got a $500,000 in your retirement plan. You are a junior partner with the IRS. They're going to take 30% of that. And that's what the RMD is. It's called a required minimum distribution. In a language only the legislature can come up with, what that means is by April 1st of the year following the year that you turn 70 and a half, you need to start taking your money out. And if you fail to take your money out, then you pay a tax. Not only an income tax, but an excise tax of 50% of what's in there.
Well, Greg, talk about a solution to these problems using life insurance.
Yeah, there are two primary ways that people address this. One is with a Roth conversion. And the Roth conversion is a method that you can use to transfer your money that is in a 401k and systematically move that over to a Roth, where you can then pull it out as tax-free income down the road. So that's one approach that people use. Frankly, I found that most people don't like doing that because they have to write a big check to the IRS in terms of taxes currently. The other approach that we tend to use more frequently is what we call an IRA reboot, where we use various insurance-based products to be able to convert what was taxable income to tax-free policy loans down the road. That allows the client to be able to get tax-free income and reduce their overall tax expenditure to the IRS. So what most people don't understand is while they're in accumulation phase, building their nest egg, they need to be looking at these type of options to diversify from a tax perspective their portfolio. Failure to do that can lead to these problems that we've talked about in terms of an overall tax burden. So we use this reboot process as kind of a fail-safe method at the tail end to be able to recover for bad planning.
Greg, thanks again for sharing your time with us.
Thank you, Scott.
My guest has been Greg Dupont in Dublin, Ohio. And this is Retirement News Online. Thanks for watching.